Hello, everyone, and thank you for the pleasure of being able to present to you. This is the November Cereus Happy Hour. One of these days, when I'm confident that I'll be able to do this presentation under the influence, I'll probably have a beer during these. They're meant to be sort of a fun and interactive way to basically discuss real estate. And um, Today's session for Cereus Real Estate is going to be the first one that I'm going to make available publicly. So it's going to be in its entirety on the YouTube section. So at some point at the end of the presentation, I'll cut it off and we'll have some time for Q&A. But for now, we're just going to jump right into it. All right. So this is me. I'm Daniel Shin. I'm a urologic surgeon and real estate investor. And for a number of years now, I've produced content in the form of a blog and on video content as well under the Darwinian Doctor name. Earlier in 2024, I started Cereus Real Estate basically to offer excellent, vetted, passive opportunities to invest into real estate. And with my own experience, I've purchased and own about 30 units of my own property, as well as being a general and limited partner of 360 units of apartment units. So I wanted to since this is going to be the first one that's publicly available, I wanted to just take a few minutes and talk about my story. So I was born in New York City, and my family was a first generation of Korean immigrants. And as soon as feasible, my parents moved us out to the New Jersey suburbs, and we had this very idyllic suburban existence there. And that was what I recall quite clearly from kindergarten through elementary school until we hit middle school. And the problem with this all was that there was no real personal finance education, as far as I can tell, that my parents had. So there's really no investing going on during this time, and certainly very little savings. Savings that we did have was in cash. I clearly remember some instances of seeing my mother, stashing some cash away in the closet, for example. Uh, Unfortunately, what happened is that around that time when I was in middle school, the economic environment of my dad's industry, which was being a commercial real estate broker, it really took a turn for the worse. There was a recession, and all of a sudden, this suburban bliss went to a feeling of financial scarcity. There was a lot of arguing all of a sudden between my parents. One weekend, moving trucks just showed up in front of our home, and we had to suddenly pile everything into the moving trucks, move across town. And it became evident that's because our house was being foreclosed upon. So from middle school through high school, this was really what I recall, a lot of stress and mainly financial. So as I sort of became an adult, my solution was to escape this financial scarcity through education. And I was an excellent student. I was valedictorian in my high school, went to Yale University, and I decided that I was going to go pre-med because I knew a few things about medicine. Number one, doctors were well respected. Number two, they made a good income, and it was a way to help people. And I thought that it would be a good way to put my skills to use and also finally get that financial sort of stability that I really desired after those many years of financial stress. So I did it. I started on that conveyor belt that so many of us know related to the, industry and becoming a physician. I went to the University of Pittsburgh School of Medicine. I went to the USC urology residency, which was a 6-year program. And I recall quite clearly that was tremendously challenging. It was one of the most challenging 6 years of my life, I would say. But I got through it. And then afterwards, I decided to go straight into practice with the Kaiser Permanente in Orange County. And I did that for a number of reasons, but I wanted a stable paycheck finally. I had a lot of debt. I was supporting my parents. I thought, okay, it's time to start making that doctor's salary finally. And at that point, I had pretty much accomplished everything. I had this prestigious job. I did have that big paycheck that kind of was going up the more years I put into my attending career. I was married. I had kids. I had that big doctor house. I had a Tesla Model 3 that I drove back and forth on the congested California highway system. I had a beach club membership. This is actually a shot from the beach club in Santa Monica. My kids were in daycare or private school as they got a little bit older. And despite all of this bliss, there were cracks in the foundation. So I was driving a tremendous amount in the California traffic, a 10-hour weekly commute. Uh, whenever I did do call at the hospital, it was exhausting and I'd be useless for, a day or two afterwards. And there was this, they talk about how when you're an employed physician, you're part of this machine. And there was this endless pressure to increase productivity in the department and see more patients. I really never saw my kids at this time because I had that 1 hour commute both ways. I never saw my kids because I would leave before they woke up and I would get home maybe when they were going to bed. Maybe I would see them conscious for half an hour before they were going to sleep. But that really didn't sit right with me. And I also still had $300,000 of student debt for medical school that I deferred through residency and just grew during those 6 years residency, and that weighed on me. Additionally, being in California, the highest sort of marginal bracket of my income was being taxed at about 50% when you combine the federal and state taxes. And that basically meant that part of the year was entirely going to taxes. None of that was benefiting myself. And on average, that was about a 35% tax rate. So you say a third of the year, I was working for the government. And I understand how important taxes are and everything like that. But that did seem like a pretty high rate. So with all of these things that we were doing, all of these costs, at the end of the month, it didn't really seem to make sense to me where all the money went. It seemed like our finances should have been improving at a faster rate than it actually was. I also started to see some cracks in the US healthcare system, being on the other side of medicine and finally understanding sort of the finances. A couple of years of my time at Kaiser as chief of the department, I got this inside look into sort of the administrative side of things. I had some worries about US healthcare overall. And I came up with a few possible solutions. Number one, I could just forget about it, enjoy the joy of being a physician. A lot of it is very rewarding, and just do that same thing for 35 years and call it a day. And then, just like so many people have done before us, I could quit my job and join the circus and really, live the freedom that I really wanted to. Or what I decided to do was learn how to build wealth, passive income, and financial freedom to really give me that autonomy to make those decisions and seize that freedom for myself. So that brings me to you. Why are you here? Why are you watching this presentation? And I think it's probably for the exact same reasons as me. You want financial security. You want passive income that can lead to less pressure to get income from your job, which will lead to time freedom. And many of you want to leave a legacy for your kids. You want time to pursue your own interests. And, maybe you're finding that very difficult now in this time where you're working a lot and you don't have much time to your own. So when I was going through this sort of development and this awakening, as you might call it, I thought of really two possible vehicles to achieve this financial freedom that I was hoping for. And I carefully considered real estate versus stocks. And when you're thinking about stocks, to take that in the beginning, what kind of benefits does it offer? Appreciation, sure. Strong liquidity. You could sell it at any time or you could buy more. It's easy to get rid of. It's easily diversified. You could buy an index fund and easily purchase your way into 1,000 companies at once. And then it does produce a small, modest return in the form of essentially dividends or, some payments that can be compounded over time. And then in terms of tax, it is tax advantaged in the long term because there's something called the long-term capital gains rate. So it's certainly not zero, but it's taxed a little bit more efficiently than, say, your actual average income in your day job. But then when I learned about real estate, I liked it even more because I felt that these qualities were really great. It's a physical asset that appreciates. It produces a significant return when you rent it, and a lot of that return comes in the way of cash that can be used to directly offset your day-to-day expenses. And it's tax advantaged via depreciation in a way that's much more powerful than just the capital gains rate. And finally, it's inflation protected via the use of leverage, as in there was a day and age where you could get a low interest loan. Now those interest rates are a little bit higher, but still, you get this fixed interest rate, and then that stays the same despite inflation degrading the value of the dollar. So the value of the debt goes down over time via inflation, but you still own that asset. So it's inflation protected. And after all, what is your biggest expense? As working citizens in this country, your biggest expense is not your mortgage, not your car, not the grocery bill. It is taxes. So if you can defer taxes or owe less in taxes, you can greatly accelerate your wealth growth. And real estate is a uniquely tax protected asset via depreciation, as I mentioned. And there are these a host of other strategies that can really supercharge the tax protection. You can take depreciation and use something called a 1031 exchange to make a tax-free exchange of one real estate asset for another. And when you die, if you own real estate, you get what's called a step up in basis. So when you pass down these assets to your children, they inherit it at the new valuation at the time of your death. They don't pay for all of those gains that you've had over the course of your life and ownership. So I've always been a very data-driven person. And the thing that really drove it home for me was average returns. So stocks, if you consider the average return of the stock market over time or index funds like the Vanguard Total Stock Market Index, you're likely to get about 8 to 10% over time. And that's just the average. And sure, if you invest in one stock like Nvidia at the right time and you catch it on the upswing, you could blow that 8% out of the water. But if you do it at the wrong time, you can really lose. So I'm just saying averages with index funds, you're likely to do 8% with stocks. Now, what about real estate? So I'm putting 15% here because that is the average rate of return, I would say, that you're going to be looking at when you're thinking about passively investing into something like a syndication. And when you compare this over time, I just have this chart here to show you the difference of 8% versus 15% over time. So in this experiment, we've started with $100,000 and we're compounding it every year, as in we're adding 8% of the value to the original. We're not adding anything to that initial $100,000, but we're just putting it out over time. This blue curve down here, which is, modest, but it's certainly curving in the right direction, after 30 years shows that if you start with $100,000, you'll end with $931,000 at the end of it. Certainly not a bad return, and it compounds from just $100,000 to over 9 times as much. So that's the power of compounding interest. That's why it's such an interesting thing. But if you compound it faster using a higher interest rate, you can see the difference. Instead of just $900,000, you have almost $6 million, $5.7 million after 30 years. So this goes to show that if it is possible to get a higher return in investing, you should definitely go for it. And, this is relevant to physicians because I think that medical professionals and physicians, there's so much training involved before you finally start making that attending salary that you have a shorter investing and earning window. So some of your mind must be thinking about how to maximize your returns from your investments. So this is a good illustration of that. I wanted to take it a step further, though. So, I think all of us have a certain timeline in mind, and we might think, what is a time by which I want to have this net worth or this amount of wealth so that I can think about retiring or I can think about going half time? And for a lot of us, it's not 30 years. For some of us, maybe it's 10 years, maybe it's faster than that. So this is, I would say, actually a more realistic summary of what can be achieved with, frankly, a higher salary of a high income medical professional. So this is, I'm calling it real estate plus. So this is this yellow line here that you can see vastly outpaces the lines from the previous chart, the red and blue line here. The yellow line is starting at $100,000, just like the other two lines, getting a 15% a year return, but also adding an additional 50,000 a year investment every year. So let's see what the milestones are for the yellow line. At year 6, you're at about a $500,000. At year 10, you've already hit $1.2 million. So whereas in the previous example, it took you 30 years to get to $900,000 from just the gains on that initial $100,000. Of course, if you keep on adding more capital, you're going to compound much faster. So at year 20, you've got almost $6 million. And year 30, you've got about $25 million, which I don't know about you, which sounds like an astronomical figure to me. So this is just some showing that if you combine regular investment with a relatively high interest rate or return, you can really, really, really start to compound a large amount of capital. Okay, so here's the, big question though. Can you really get 15% return? And you can. So the Hampton Meadows deal, which for anyone on the Cereus Real Estate investor list, you've seen the details on this. The average annual return is projected at 20% annually over the 5-year timeline of the deal. And if the SEC is watching this, it's a 506C deal for accredited investors. So I can talk about this publicly, okay? Don't come after me. Now, the caveat is that I would admit that real estate is a higher risk endeavor than index funds. I would say that if you're an individual investor and you want to invest in stocks, you can get a good return by doing something like the Vanguard Total Stock Market Index. And you have, I would say, unless the entire world implodes, it's going to not go away because it's a very diversified type of investment in stocks. In real estate, you're putting a lot of eggs in one basket, even though you might have that risk spread across 350 units of property, it's still one geographic area, one building that you're investing in. So I would say that real estate is higher risk. But the reality is that, the actual projection, the actual performance of a deal, it might undershoot or it might overshoot the projections. So that is a caveat with real estate. However, these numbers, I would have you remember, is just on the basic return and the basic capital that you're putting in. It's not even considering the benefits that you can get from tax benefits. So you might consider that when you get returns, generally those are going to be taxed as you go. But if you can defer a lot of those as well, or even get write-offs and things like that, that can greatly increase the value of these returns as well. Bottom line, higher potential returns equals higher potential wealth growth. And I think that's really relevant for medical professionals who spend so much of our formative years studying and taking tests and training before we finally start gaining that income. Okay. All right, perfect. So the deal was I would talk about cap rates this happy hour. So I wanted to spend a little bit of time just going over cap rates. So cap rates is short for capitalization rate. And this is a term that defines the expected return on an investment property. And if you start investing in real estate, if you're dealing with just 1 unit, 2 unit, 3 unit, 4 unit deals, you may never hear the word cap rate. But the moment you start venturing into what's called the commercial side of residential or 5+ units, you're going to hear this term thrown around a lot. So I think it behooves you to understand what this means and be facile and sort of understanding cap rates. So basically, it defines the relationship between two things, the net operating income, which is gross income minus the expenses, excluding debt. And I'll go into that in a second. But the other thing is current market value. So net operating income, just to review, is all of the money that a property makes. It can include, the vast majority is going to be coming from rent. So it's the rent income, and that might include the rent from just the tenants, but also maybe they pay pet rent because they have a couple dogs or something like that. It can include laundry income from the money that people are paying to utilize your laundry facilities. Maybe it also includes fees like late fees and application fees and various other things like that. Okay, so it's all the money coming in from the business of the apartment building. That is a net, that is a gross income. Okay, so what are the expenses that you might run into? So expenses are going to be things like property management, utilities, if you pay for utilities. It's going to be things like maintenance, so fixing the ACs or replacing the light bulbs and making sure the place is clean and painted and all that stuff. So those are all the expenses that are going to take away from the gross income. So gross income minus those expenses equals net operating income. Debt, like a mortgage, is usually not included in this because there may be no debt on the deal, or there may be a really big mortgage. So since that is such a variable, it's generally excluded from net operating income. So current market value is just what someone would pay to buy your property right now. So this term, capitalization rate, it defines this relationship, and this is how it's related. So cap rate equals net operating income divided by the property value or the purchase price. Okay. And here's an example. So say you're looking at a property with an annual net operating income of $100,000 and it's priced at $1 million. That's what I would pay to buy it. What's the cap rate? It's 10%. Okay. Does that make sense? $100,000 net operating income or NOI divided by $1 million is 10%. And if a building is doing that, and that is sort of the going rate for that building, you could refer to that building as being a 10 cap. All right. And when someone says that, you should intuitively understand that if it's $1 million and it's a 10 cap at a 10% return, then you might think that the net operating income is going to be somewhere around $100,000 a year. Okay. So that is the value of cap rate and understanding this. The thing about cap rate, so say you have a higher cap rate, like 10%, the thing is that is fairly high. So it might indicate that it's a higher potential risk type of building because usually if you're generating that type of return, it might be in a sort of a dicier area. So maybe it's a C class or something like that property as opposed to an A class property. A lower cap rate property is usually found in premium markets. So what does that mean? Los Angeles, New York City, Seattle. There you might see cap rates as low as 3%, 3.5%. That might denote that it's the value of the property is so high, and the relative rent is lower, so that when you do the math, it comes to only a 3.5% cap rate or something like that. So generally, lower cap rates means a higher demand urban area. So there are limitations on cap rates, though, because the thing about cap rates, yes, it can help define the relative value of real estate, but it can also definitely be subjective because you don't really know what the sale price or current market value of a property is until you go to sell it. And a seller can say, my property is really great. I know the market and I know that this is a good quality unit and this is a 4 cap property. And a buyer can say, no, 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 I think that your property is lucky to be a 5 cap property. And there can be definitely a subjective sort of uh, argument when you're trying to decide how much you're going to pay for a property. And just between a 4 cap and a 5 cap, that could be a 20 to 25% valuation difference. So on that NOI of $100,000, a 4 cap of $100,000 is a $2.5 million property. But if the buyer is saying, no, this is actually just a 5 cap property, the area is not as good as you think it is, that's only a $2 million property. So you can see that's a huge difference in valuation, and it could be subjective. I think there's a question here. What's the average cap rate range that we should be looking for? So it depends. It depends what your strategy is. So if you're going for something that you would like to generate a good amount of cash flow, you might be willing to accept an area that might be a B or C class area that typically can generate a higher cap rate. I'm sorry, a return that is commensurate with a cap, of 8 to 10%. And on the other side of that equation, you might just be going for capital preservation. So you might be willing to break even or even be slightly cash flow negative if you think that owning a property in, say, New York City is going to do really well in the long term and is going to appreciate. And you don't care that you're not making a great, cash flow, or that you're even having to support this property because you're getting a lot of equity and appreciation in this property, and maybe it's a tax play for you. Maybe you want to buy a new property and take a huge tax write-off in the beginning. The more I do real estate, the more I understand that a lot of these deals where numbers don't really seem to make sense if you do a formal analysis, it's because something else is going on. It's because the buyer is not only looking into this deal for the purposes of owning a cash flowing property, maybe they're utilizing it to gain an enormous tax write-off. So when you think about, what's the cap rate I should be going for, another thing to think about is that if the debt that you're going to be using is, typically a loan from the government, like Freddie Mac or Fannie Mae, and interest rates have been pretty high on those. They're starting to come down now. The Federal Reserve is, I think, probably going to be dropping interest rates even further soon. That can change the equation. But if you think that you're only going to be making an 8% return on your 8 cap property, but your debt is at 8% or 9%, then it really doesn't make sense to buy that property because you're going to be paying more in the debt service than you are going to be gaining in the income. All right. So, but typically, when I'm looking at a property, I'm probably going to be looking to take a property that can generate a 8 to 10% return, or I need to be confident that after I improve the property, I can make it a higher return. So it would be nice if I could take a property that I purchased for at an 8 cap and then take it from an 8% return to maybe a 12% or 13 or 15% return on a cash flowing basis. And then when you sell the property, you can make an even bigger return on the appreciation. All right. So, but long story short, it kind of depends on your strategy and what your incentives are. So the last part I want to go into here is just a little bit of a discussion about what might happen in the real estate investing world now that Donald Trump has won the presidency. So here are the potential outcomes of a Trump presidency. And these are just things that I think may happen or might be likely to happen because Donald Trump, number one, is a real estate investor himself. And a lot of these things he has talked about doing if he were to win the presidency, which he has done. So a lot of people think that he might renew a lot of the tax breaks of the Tax Cut and Jobs. Did I get that wrong? Tax Cut and Jobs Act? I think that's it. But essentially, his signature tax policy might be renewed because a lot of those things are sunsetting. For example, bonus depreciation. So one of the biggest tax breaks in real estate is depreciation. And under the Trump tax plan, you were able to stuff 15 years of depreciation into year one, 100% of it. And that produces an enormous paper loss in the first year that for real estate professionals could by itself make the deal an incredible deal. So that's stimulatory. It basically promotes the trading of real estate, the purchase of real estate, the sale of real estate. So a lot of that can be really stimulating for the economy. That 100% depreciation, though, sunsetted. So it went to 80% and now is at 60% in 2024. So there's a lot of people who think that now that Trump is president again, there might be a return to 100% bonus depreciation as early as next year. It's possible. Um, Another thing is, a signature piece of the tax legislation under Trump was opportunity zones. So it's actually a good idea in theory, but it's a designation of certain areas in cities generally that are blighted. And if you invest in these areas and you hold it for a particular, period of time, essentially that property becomes untaxable. Like all of the gain that you have, you get this step up in basis, and it just becomes an incentive to not only invest in blighted areas, but also hold on to the investment and keep it maintained. It's a good idea in theory. It's hard to know in practice how this actually benefited cities because a lot of these, the data isn't really readily available. Um, but certainly that is also something that could be renewed under the Trump presidency now. I think there's a certainty that Donald Trump is going to be exerting pressure on the Federal Reserve to decrease interest rates faster, to loosen, the financial markets and decrease the cost of borrowing money. Whether or not that's going to be effective, who knows? They're technically a completely independent organization from the legislature and the presidency, but um, certainly he has a loud bullhorn as president now to put pressure on them. Along the same lines, there's likely going to be less regulation on lending, or sort of a more lax environment in the lending markets. Again, that's stimulatory. The downside of all of this is that too much of these policies can lead to economies that are overheated. It could lead to housing bubbles. Um, in the short term, I think honestly, I'm expecting a really good environment for real estate investment over the next 4 years and, maybe many years to come. A lot of, uh, not to get political in terms of partisan, that is, uh, but there is a very, very, very good chance that we're going to have not only a Republican president, but also a Republican Senate. That's confirmed. Also, a Republican House of Representatives. So his ability to pass very stimulatory economic measures, tax cuts, all of this, it's probably going to be very easy for him to do that. So that's all I've got today. We're going to end it there. The um, Again, this is going to be sort of the first in many of these that will be publicly available on the Cereus Real Estate, website, YouTube website. I'll be pushing it out to the investor list as well, and also to the rest of my social media. And just to talk a little bit about Cereus Real Estate, Cereus Real Estate, the goal of it is to offer high quality passive investment opportunities to high income medical professionals and allow you to get closer to financial freedom. I have these very lofty goals for Cereus Real Estate to help bring thousands of medical professionals closer to financial freedom. And that's what I hope to do along the way. I also hope to educate and increase your knowledge of real estate investing to make you comfortable with the concepts and help you make an educated decision. Hannah said, can you help explain how we use the tax benefits from the Hampton Ridge project? Sure. So let me do a little bit of Q&A. I'm actually going to stop the recording. Everyone who wants to can come on screen. We'll just have a little back and forth here. But again, for everyone just watching at home, thank you very much. Thanks for tuning in, and I'll see you next month.